Hi, I'm Ty, and in this video, I'm going to be talking about financial planning and analysis for digital agencies, and specifically, I'm going to be talking about analyzing cash flow and cash flow specific key performance indicators. This is the third video that I've done on the FP&A topic for digital agencies. The first video was an overview of our process for financial modeling in general. When I say our process, TCA's process. The second video was looking at how we would analyze profitability and the key performance indicators for earnings and profitability that we would recommend for digital agencies. And now we're getting into the third video. So if you haven't seen the first two, I'd recommend that you go over there and check out those first two videos and then follow up with this one, because this one kind of follows the chain of logic follows from those first two. But otherwise, we're happy to have you here, and we'll get started right here in talking about cash flow and cash flow specific KPIs. The reason I say cash flow specific KPIs is that if you take a look at this spreadsheet that I have here, which is providing an example of a company's reconciliation of their earnings, EBITDA, which is generally on an accrual basis, to the actual cash flow per month, what you see is that earnings is the primary driving factor, which is why it's really important to analyze those. But then there's other factors that will affect your cash flow, like when you see down there the AR, that stands for accounts receivable, the change in your accounts receivable, which is a function of how much bills you're sending out and how quickly you're collecting on your invoices, or your change in work in process, which is a function of how much work are you doing to earn income that you haven't even billed for yet, right? Or your change in AP, which is your accounts payable, how quickly are you paying your vendors, or your line of credit, which is borrowing money perhaps from a bank in order to kind of meet some seasonal cash downfall or whatever, right? So these are all other things that are not that independent of profitability can affect your cash flow. And so that's why I refer to as cash flow specific analysis, cash flow specific KPIs, because any analysis of EBITDA is going to drive to an analysis of cash flow. So analyzing EBITDA is analyzing cash flow as well, but there's more to it than just cash. When we look at these factors, these changes in these what we'd call accruals or deferrals, they are cash flow specific. What happens with them stands independent of what happens with earnings and how they affect your cash flow, essentially. So in talking about that, the KPIs, the key performance indicators that I'm saying would be specific to cash flow, which we would recommend at a minimum looking at, are your days sales outstanding WIP. So this is how long is your WIP outstanding before it ultimately becomes revenue. Secondarily, your days outstanding receivables. How long are your receivables outstanding before they are able to be collected? Your days payable outstanding. How long do you let your invoices sit before you pay them, right? Each of these could be broken down further, but these are some basic cash flow metrics that we're going to describe in more detail here. The first one I'm going to talk about is days sales outstanding. Okay, with days sales outstanding, if you look at this chart here, first off, to do the calculations, I've got a line item for showing the days in the month. I've got the actual revenue that is being earned per day. That's the revenue that would be used in the calculation of earnings or EBITDA. It's on an accrual basis. And then I've got what I call DSO WIP, DSO receivables, and DSO total. So what this is telling us is that in total, I think it's helpful to skip down to the third one, and it tells us in total the day sales outstanding between the time that you do the work and it goes into work in process and the time you actually collect cash. Now think about that. You do the work, it becomes work in process, you then bill your client for it, and then if you give your client payment terms, like you don't collect up front ahead of time, that would be a different scenario, right? And that's good on you if you do that. But if you don't do that, you've done the work, you send out a bill, and then maybe you give your client 15 or 30 days to pay the bill. What we're saying here is when you look at that DSO total line, we're saying that in all months, January, February, March, on average, it's taking 75 days from the time you do the work to the time you collect the cash. And then on the line items just above that, we're breaking that down even further. We're saying, well, if you want to know the components of that 75 days, it's taking 30 days on average to collect your receivables. So from the time that you actually issue the invoice to the customer, it takes 30 days to actually get paid. Now that would make sense. If your terms are 30 days, then what else could you expect, right? So that would kind of make sense. So then we're saying, well, of the 75 days it takes in total to get paid, between the time you do the work and you get paid is 75 days. Between the time you send an invoice and get paid, it's 30 days. So what that means is, on average, you're doing the work and not sending out an invoice for 45 days. So your DSO WIP is 45 days. And so both components, when you're in a professional service environment, when you're in a digital agency environment like this, you have to consider both components in your cash flow cycle. Not only how long does it take to collect on a bill that you send a client, but how long does it take for your team to actually bill the WIP, to bill the work in process. That plays into this, right? So managing both of those, tracking both of those, seeing what you can do about shortening both of those will improve your overall cash flow. Okay, and then what else I'm showing you in this chart is the accounts receivable, and then I've got what the WIP balances are. Now, this is somewhat derivative, right? This is an academic example, so we can look at this either way. We can say that the accounts receivable and the WIP that I'm showing there, we can say are actual numbers. Like the months of January, February, March, we're talking about 2019, or any year. I guess I shouldn't put a particular year on it, but we're talking about the first quarter of any particular year that has already happened. Those are actual numbers, and so then we would say, well, the DSO numbers that you're seeing above are calculated. They're actual numbers based on on actual calculations from actual receivables and actual WIP and actual revenue. But you can look at this from a different perspective. What if I were to tell you that we're talking about January, February, March of the following year? This is a forecast. This is a plan. We're planning. These are targets. Then the way we would think about this is we would say that the DSO WIP, the DSO receivables, the DSO total, that this is not what's actually happened. This is our target. This is what we believe in our business plan is what we can achieve, what we want to achieve, however we want to state that. Maybe it's the minimum we want to achieve, whatever, but this is our plan. And so what we could do there is, if those three line items, the DSO line items, represent the KPIs as we are planning them to happen, what we're planning to achieve, then we can use that with the revenue per day to back into what we're forecasting our receivables and our WIP to be. What we're saying is, in that context, accounts receivable and WIP are not what actually happened. It hasn't happened yet. They are a forecast of what accounts receivable and WIP will be based on what our target for DSO is. I hope that makes some sense, and that in the way we're looking at this chart here and in the way I'm describing this analysis, we could be talking about this as after the fact analysis of what actually happened, or we could be talking about this as a way to set targets and forecast what we think will happen. Okay, so let's take a look at days payable outstanding. Okay, so this is the other side of the equation. This is looking at the operating expenses. All things being equal, if it wouldn't hurt our vendor relationships or cause us to have problems with being able to perform for our customers because we don't have our vendors happy helping us out when we need them, then that's what I mean, all things being equal, you would think, well, we want our DPO to be as long as possible. What I mean by that is, the longer the DPO is, the better cash flow we have, because what that DPO stands for, days payable outstanding, when I say 30 days, is we're saying it's on average taking us 30 days from the time that a vendor sends us a bill to the time that we actually pay that vendor. If we could somehow increase that to, say, 45 days, we would be improving our cash flow. So that's a pretty simple concept, and a lot of times we don't have a lot of control over it. I mean, we're getting invoices from vendors. A lot of these vendors we need, they're important to us, and so they may set terms like 15 days. Our best vendors may have like 15-day terms, and so our DPO ends up being shorter, and that's not something that's necessarily in our control, but it's good to know from an analysis perspective that that's what's happening there, and that's affecting our cash flow in that way. Well, that's it in terms of cash flow specific metrics. As I mentioned at the beginning of this video, I would encourage you to take a look at all three videos and view them in concert, so to speak. So the first video being kind of an overview of our overall TCA process for building out a planning model or modeling, financial modeling. The second one being looking at EBITDA and breaking that down, analyzing it, and the key performance indicators that we would look at for a digital agency regarding earnings and profitability. And now in this video, we've closed up this topic by talking about cash flow specific metrics. How are we, what is our cash cycle from our customers in the sense of from the time we do the work to when we get paid? What does that look like? And what is our cash cycle with vendors from the time that we get a bill? How long does it take us to pay, and what does that look like? Now, a couple things that we didn't address in this video that could be relevant to your agency and would be something to look at is you may have much more favorable situations than what we see here, from the standpoint of maybe you bill your customers up front, maybe you have what we call unearned or deferred revenue, and so tracking that and analyzing that is going to be very good news from a cash cycle for you, of course, because you're getting paid up front. But the primary issue there then is you're often living off of tomorrow's earnings, right? So you've got cash in today that really is yet to be earned. You're supposed to do the work for it tomorrow, and if you're living off that now, that would be the thing to watch there. So that's just another thought on that side. And yeah, that's it on this topic. I'm gonna see you later. As I've said before, if you enjoy these videos, if you're finding value in them, please share these with your friends and colleagues. Subscribe to our YouTube channel. It would mean the world to me. Thank you, and I will talk to you all next time. Bye now.